Ladies and gentlemen, welcome to the next edition of the Risk and Regulation News Channel. My name is Martin.neisen, I'm a partner with PwC and I'm today your host. Similar to the previous episodes of the Risk and Regulation News Channel, we will talk today about the SREP results of the ECB. And today we will pick a special topic, and I would even say it's the most important topic for the banks. It's credit risk. And like always, I'm not speaking here alone for you today. I have a guest, an absolute expert on the topic of credit risk. It's Luís.Barbosa from PwC Portugal. Luís, would you like to introduce yourself?
Hi Martin, yes of course. So my name is Luís.Barbosa. I have the pleasure of being leading the risk and regulation practice in Portugal, but within our European network for almost 6 years I'm participating in several initiatives on the credit risk side, on modeling, but also on risk management. So it's a pleasure to be here today with you.
Thank you very much. Thank you so much, Luís. Luís, let us let aside the tumults currently with regard to the Russian-Ukraine crisis, which has definitely an impact on credit risk. Today we want to focus on the SREP results on credit risk. And when you look to the SREP report of the ECB, one thing is a little bit strange or even surprising, that on the one hand side we have a quite sharp decrease in the NPL ratios coming from 2015 with an NPL ratio of almost 7%. Now in the end of 2021 we are down at around about 2%, even considering the COVID-19, and of course there are still some uncertainties. Nevertheless, when we look to the qualitative results regarding credit risk management, the ECB is very critical. There was even a quite significant movement to the grade 3 of the ECB report when it comes to credit risk. Luís, you're an expert on this. Can you explain why this happened?
Well, Martin, I will say that this is the consequence of seeing the present but living the future. So although during 2021 we face an improvement on our macroeconomic conditions, there are, of course, strong reasons to support this apparent contradiction. First of all is that the ECB is conscious that several governmental and monetary policy measures, together with national, public and private monetary initiatives, somehow helped preventing a surge in terms of bankruptcies and NPLs. We also know that the public and private debt to GDP ratios, they did increase in the meantime. The ratios of forborne and stage 2 exposure, they grew, although modestly, but last but not least, we are also noticing the persistence of the supply chain bottlenecks. So there are reasons that somehow support the concerns that all the measures, the extraordinary measures that were implemented, if they come to an end, that basically we may finally get all the impact or the full impact of the pandemic. And that's of course a problem. And we are not yet talking about, for instance, the current concerns on inflation and the current market turbulence. So I will say that we are still at half of the game, and basically the ECB reflect that in their SREP classification.
Thank you very much, Luís, so far. But is it also correct when I would say that the ambition of ECB with regards to credit risk is that it cannot be ever enough, that they always want more and that they set the bar always higher and higher each year? Is that correct, or is it maybe only my own feeling?
I mean, I think the same. So the ECB is acknowledging that the challenging times, they really require specific measures. So meaning, I will say, extra pressure and focus. And the Dear CEO letter that was issued in 2020 really set the tone. So we all know that traditional credit risk management frameworks, including supportive tools and processes, they work pretty well in the context of stability, or where at least you know that past data can really explain the future. But we know that all the extraordinary measures somehow blurred the borrower's creditworthiness and challenged banks' capacity to manage credit risk. So the capacity to anticipate actions. And the focus of the credit risk within the 2021 SREP cycle was precisely on the quality of the control. So the capacity to assess the correct and timeliness identification of distress exposures, as well the capacity of banks to reflect those issues in managing and reporting so that they can really take proper action in terms of solving those issues. And when we look to the numbers, and it's always an important message to retain, 26% of total SREP qualitative measures, they were related with credit risk, so it's the second largest close to internal governance. 2/3 of the banks, they really kept the same score, but 1/3 went to a worse one, so which is quite significant. 70% of the banks, they received qualitative measures, and the main topics here were identification of NPEs, classification as forborne or delays in recognizing UTPs, and also the functioning of early warning systems. So basically all of this was the main reasons why this deterioration in the overall classification. And on top of that, I would also add the concerns with reclassification across FRS 9 stages, but also on collateral valuation. So this is also a topic that we should never forget in this context.
Okay, thank you very much, Luís. So it seems really to be a very tricky situation. On the one hand side, we have the macroeconomic circumstances that got a little bit better over the last years. Now we are again in a crisis. We have the situation of COVID, we have the Ukraine-Russia crisis. And of course, as you mentioned, there are a lot of qualitative findings of the ECB that they publish in their SREP letters. What is your recommendation? How should our clients prepare for the next season? I mean, they are all making their plans now for the next credit risk projects on what they should focus on.
Martin, I will say that firstly, we need to look a little bit deeper in terms of what are the priorities of the ECB on the credit risk. So what were the main areas that they identified as relevant? So I will highlight here to correct the deficiencies in credit risk management frameworks. So targeting the timely identification of clients' financial difficulties, look into the forward-looking perspective and the linkage with provisions, and also the focus on risk mitigation on collaterals. And we will expect follow-up actions on the CEO letter, targeted reviews on the adoption of the EBA guidelines on loan origination and monitoring, and broadly speaking, on how credit risk is being identified, monitored, and assessed overall. There is another area that was identified, which are the most vulnerable sectors due to the COVID pandemic, and basically commercial real estate here clearly spots because the demand is shifting down, and this brings concerns about also the valuation of the property per self. So we would be expecting here several OZs or targeted reviews in banks where commercial real estate exposures are relevant within the portfolio. And last but not least, leverage finance. So the search for yield in a sustained or a prolonged long interest rate scenario that is going to come to an end real soon, but also the abundant liquidity tend to foster the buildup of risks in this area, in this segment of leverage finance. So here we are going to expect from DCB a recap of their guidance that was issued in 2017, and here focusing on topics very specific like the creditor underwriting standards, the syndication of risk, the risk appetite, and the calculation of capital requirements. So again, here target inspections will be expected, and therefore banks really need to be ready to tackle these three areas. Going further in terms of all the context that we are living now, so banks really need to look again to their credit risk management frameworks. I know they are relatively sophisticated in the way they address all these issues, but the current context will put them at the maximum challenge, and therefore time and resources are needed in this area too.
Thank you very much, Luís. There's one topic, that is in the back of the mind of the banks in many areas, also within credit risk, and that is ESG. ESG is the, I would say, most important topic for the finance industry right now. And of course, ESG risks are also reflected within credit risk. And of course, banks have to incorporate ESG risks into their credit risk framework. Do you have any suggestions for our clients how this point should be tackled, how banks can prepare on this?
Martin, I will say that there are 2 or 3 key areas here. First of all, it's all about understanding the transition risks. So basically try to look to clients' business plan, try to understand exactly how their ESG pathway is going to put at risk their revenues or change their cost structure. So again, banks really need to understand who their clients are, how they are really facing the challenges of transition risk, and therefore how their business plans are aligned with, for instance, their amortizing plans linked to the exposure that they have or agreed with their clients. Beyond that, it's all about gathering data from their clients. So it's not only asking questions about how business is going on, it's also looking to emissions, it's also looking to the collaterals, to the placement of those collaterals. So basically there are a lot of data which is not so traditional in the banking business that needs to be brought into the game, and banks need to organize themselves and how they are going to obtain this information and update it in a regular basis. So all about challenges in terms of credit risk, all about gathering data for their clients, and afterwards how they can really achieve their targets, for instance, in terms of their GAR ratios. So basically we all know that on average, banks are not 100% aligned with the green in terms of the taxonomy. The significant part of their portfolios are still brown. So basically, it's very important to have a clear plan on how to support clients moving from the brown area to the green area. And basically, this implies bringing strategy, implies being here, in some cases, first mover, but at the end of the day, to support the clients in all this transition. So these are the main areas that I would like to highlight in this domain regarding ESG.
Thank you very much, Luís. Yeah, ESG is such an important and big topic that I'm pretty sure that we will have a separate big episode only focusing on ESG and how to incorporate it in credit risk, because there are so many dimensions that have to be considered. Luís, last question for today, and I said in the beginning that we don't want to focus on that, but of course we have to consider somehow the Ukraine-Russia crisis a little bit. I mean, the overall economic environment is not the best, the outlook is not the best. We have inflation in many countries, numbers are going up. On the other hand, the crisis leads to significant default potential, both on the indirect exposures and direct exposures. Direct exposures are, for example, exposures against the Russian state or against companies within Russia or Ukraine, and the indirect exposures are clients, credit customers that are doing a lot of business with these countries, and when they can't do this business anymore, they might run into troubles. Maybe a few words about that, what banks should do right now for being prepared for the coming crisis.
I mean, I will say, Martin, that at the end of the day, in terms of credit risk exposure, so looking to the business plans of their clients and investing, analyzing and challenging, try to understand what are the main assumptions of those business plans. So if they are dependent somehow in terms of raw material or in terms of selling places, and try to understand exactly how is this going to translate in changes in their economic performance. So this is very critical. So know more about your clients, know more about their strategy, know more about what will be the real life consequences and all the challenges, and try to size what are the buffers that will allow them to meet their obligations. This is quite fundamental. Otherwise, forbearance measures will need to be applied, and ultimately you'll have an increase in NPLs. I know we are not going to do miracles, but at least try to minimize the situations where some prudence or real-time action could somehow prevent all these evolutions. This cannot be done at the sake of much slower decision process. It implies somehow investing more sophisticated solutions. Try to train the staff so that they will be all aware of what could be the transmission channels. And of course, in terms of risk culture and dynamics, all of this needs to be upgraded, and it will be key here. Looking to early warning signals, how prevented they could be in this area, but also investing time in monitoring procedures. That should not be oriented only for reporting purposes. I think they should be targeted to the business decision process. That's where you can really benefit from all the information that you gathered. All of this would allow banks to be in the better position, together with, I will say, the bottom-up stress testing, so that they can really drive the wheel with the two hands in a really windy road, because that's what many banks will face in the next years or so.
Thank you so much, Luís. Yeah, very difficult times, definitely a lot of uncertainty, and in these uncertain times, a really good credit risk management is even more important than in other times. So thank you very much, Luís, for being here with me today. If our clients have any questions regarding these topics that we covered today on credit risk management, both from the qualitative side and quantitative side, please do not hesitate to reach out to us. Our contact details are, like always, here in this YouTube channel. So just write us an email or give us a call. And if you have any topic that you like us to cover within this risk and regulation channel, do not hesitate to write us or leave us a comment. We will definitely cover it. And yeah, I hope to see you soon in the next risk and regulation channel episode. Bye-bye.
Bye-bye. Stay safe and healthy.